Well, in general, so far, what Mr. Trump is doing is encouraging the business to stay onshore, to build, to invest, to do capex. He has big infrastructure planning, so that should all help the U.S. economy. We actually think, anyway, even without Mr. Trump, the U.S. economy is actually on a solid footing. We have seen unemployment rate coming down. The labor market is actually quite tight. We see wage growth coming back. So even without some measurements that Mr. Trump plans to do, we're actually fairly positive on the U.S. economy. We expect a growth acceleration, and that should basically lead to higher earnings growth in the U.S., in particular since inflation is also coming back. So we expect 11% earnings growth for the U.S. equity market. There's a risk to the upside if some of the corporate tax cuts that Mr. Trump has announced are coming through. That could actually even lift earnings higher. So we are pretty positive on the U.S. economy at this stage and on U.S. equity market.
Adrian, you're talking about growth acceleration and also inflation, but are you concerned that inflation will get ahead of itself and the Fed may have to hike more than 3 times this year?
Well, our expectation for now is 2 Fed hikes. There's the risk of a third one. We think there are 2 forces basically in place. So first of all, inflation is driven by higher commodity prices. Some inflation is now driven also by the tight labor market, and that basically should push inflation higher. But we think at this stage it's actually a positive environment. Inflation is not going out of loop, and we expect it will stay below 3%. So it should be a positive one for revenue growth. It should actually lead to higher margin expansion in this sense.